We'll open up for Q&A. For people who are joining us, dear journalists who are joining us from across India, there is a chat box on the right side of your screen. So if you have questions, please do type in there. I have real-time access and I will read out those questions to you. Questions to the floor here. All right, so let's start off. If we could have people introduce themselves before they ask their question. Sir in the front row.
Good afternoon, Team Horizon. Thanks for detailed presentation and briefing. I am Mehul Dani from FinTech Business. Sir, your company is facing concentration risk in terms of you are heavily dependent on industrial and e-commerce cycles, so which may lead to lack of consumer demands at certain times. So how do you address these cyclical problems? Second thing, how do you deploy technology across the verticals, across the your stakeholders, in order to gain the operational efficiency as well as to have a better, faster turnaround time? Thanks.
Thank you so much for the question. Coming to the diversification, as I alluded in the presentation, this company has not only diversified geographically. Today, if you see from north, west, south, they're effectively nearly a third or a fourth in each of the segments. But also, if you think from a business perspective, this business has significantly diversified across the product line. And coming to your question, as to why are we today significantly dependent on e-commerce or 3PL trends, as you can see that from the stat on the slide, that business itself has to get shrunk to almost 20%. We really added 50% of the business from some of this industrial segment. And the in-city, which as I alluded, has not even started to, effectively add to that diversification. As we go ahead, we've already diversified our top 10 customers that you have seen has already come down from nearly 90% to 42% in a short frame of just 3 to 4 years. And from nearly a dozen customers, today we are catering to 120 customers. And that trend is showing no signs of abatement. So I think we believe what we delivered in 3-4 years is a very, very well diversified business. And coming to your second question, sorry, I just lost the title. Can you just repeat? Our technology, yes. Thanks, Ashish. On the technology end, no, very good question. I think we've been an innovator in this segment. So if you think about the products we've got, the specific technical specification that we've got here, again, leveraging on the Blackstone parentage, learning from some of our sister companies, we brought best of development technology into this, from precast, getting solar and renewable solutions to our customers, bringing the entire business ecosystem. We're not stopping at only real estate and infrastructure, but effectively what we are creating today is a very, very innovative product which effectively, bridges the gap to a real estate to an infrastructure, bringing social amenities, social infrastructure, blue-collar housing, hospitality solutions to this. So yes, not technologically, but from an innovation perspective, I think we've been a pioneer in this sector.
Well, few of the questions, I have a few here. There's a journalist from Jaipur asking, what are the margins looking like and how is your cash profit runway?
Thanks. So in terms of margins, as I said, this is a very, very high growth business, but effectively a very simple business to manage. At the park level, we pretty much operate at about a 92 to 93% EBITDA margins. At the corporate level, even after giving effect to all our corporate overheads, we are ranging at an 80 to 82% EBITDA margin at the corporate level. Coming to our cash profits, post the IPO and the capital restructuring that we do, we nearly paid off 2/3 of our debt. The depreciation that you see on the face of our P&L is effectively book depreciation. These are very, very new vintage assets. Also, less moving parts means there's very little that the assets need to give back to the assets, which is very typical to some of the other infrastructure or real estate asset classes. All of this put together effectively means that post the IPO, we should be able to generate very high operating cash flows, almost in the tune of 600 to 650 crores on an annual basis.
Good afternoon.
Yeah. Yes, ma'am. Yes, please.
Myself Bhavika from Times Global News. My question is, how sensitive are Horizon margins to changes in land costs, construction costs, interest rates and rental yields?
Yeah, no, good question. See, what's happened in the industry also is, if you go back to the rental growth page, Prapti, the rent growth in this segment has been significant. We've almost seen early double-digit growth in a lot of our sectors already. So what has happened is, while you're right, land prices and construction costs have gone up, but so have the rentals. So effectively what that has done has not diluted any of our margins or input costs or return on asset matrix. In fact, once we factor in the fact that some of our deeper assets are almost doing double-digit growth, in some cases our margins are actually expanded.
My next question is, how does Horizon plan to counter rising land acquisition costs and increasing competition in industrial real estate?
I think, ma'am, as I said today, in this the total addressable market is humongous. The institutionalization of this sector has only just begun. Right? If you think of what grade A space is to the total industrial and warehousing space, it will probably be in single digit in terms of percentage. So competition in this sector is very, very welcome. I mean, this is something that we've seen in our commercial office segment also, in the mall segment also, and now the new growth segment that we have seen in e-commerce. Competition only speedens or fastens the pace of institutionalization of the sector. As a corporate today, as I said, a 200-member institutional team backed by Blackstone, we will always gear up for competition. So I don't think we are, what we are focused on is to bring the best-in-class infrastructure to the company, to the country. Effectively cater to these very, very high-grade, multinational Fortune 500 companies. These are companies who effectively need high-grade infrastructure. They pay for and hence ask for high amenities and have paid for those high prices that we see in our assets.
Thank you, sir.
Hello, myself Mrinali from newsindia.com. My question is that what measures can you take to reduce the dependence on your largest customer and build a more diversified customer base?
So again, going back to the diversification that we've done, we've already, as I said, we've grown from 12 customers to 120 customers in just a short span of 4 to 5 years. As the trends for industrialization continue to deepen, thanks to the government efforts on PLI and Make in India, our sense is these trends will only further accentuate and deepen the diversification that we've seen in the business. And also, if you think from our core business that we started with the warehousing, we continue to still attract a lot of these multinational companies, right? As I said, nearly 2/3 of our customer base today is these global multinational companies. The adoption by the Indian companies for such grade A institutional parks has only just begun, right? So over time, you will probably see this diversification trend only get further accentuated. Add to that the fact that we are now entering in-city sectors, that adds a completely different fillip. The customer base for in-city sectors, there will be some overlap, but that will attract a completely different set of customers to this business. So I think we are very, very excited to continue to pile on and attract new customers to this business.
And also you currently operate across 10 cities, and which market do you see as the next major growth opportunities?
I think opportunities in a core market is still very, 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 very high. Even if if I use Germany as an example today, nearly 300 to 400 million square feet total stock in the market, and the grade A stock is not even in single digits, right? So there is still a lot of opportunity and work to be done even in a core market. Having said that, we are today already present in 10 key industrial and logistics markets. Our intent will be continue to deepen and gain market share in our core markets of NCR, Bangalore, Chennai, Pune, Mumbai, Hyderabad. But very selectively, like we've done in the past, look at some of the tier 2 markets. Like in the past, you will see like Nagpur is already nearly 10% of our business already. We entered Goa in the past. So we will continue to explore opportunities to enter into some of these tier 2 markets. But as I said, today the amount of opportunities in our core markets itself is very, very vast.
We're looking to retire most of your debt from the proceeds, right? Going ahead, and we mentioned there will be scope for room for growth thereafter. Going ahead, how do you plan to fund your acquisitions going ahead? And also, what will be your debt to EBITDA ratio approximately? What's the trajectory for that? And the second question is, was there any particular reason to go ahead with the corporate IPO rather than a REIT structure?
Yeah, I think that's the question first. So why a corporate IPO and not a REIT? As I said, this company has grown almost 5 to 6 folds in the last 5 to 6 years. Starting from 10 million square feet of total development potential to nearly 16 million square feet today. We believe that's one aspect, but we believe from a total addressable market perspective, the institutionalization, as I said, of the sector has only just begun. So the amount of growth opportunity, the amount of runway that we see in this segment is humongous. While India GDP continues to grow at 6-7% real, the need for institutional grade space should continue to go hand in hand. You need more space to store, you need more space to build. But more importantly, as I said, we will continue to claw back into the market share of this grade B, grade C, call it grade B, fragmented, mom and pop, regional developers, going ahead, which kind of happened in the commercial segment, is happening playing out in the residential segment, is playing out in the malls, retail segment, and I think it's just about time it plays out here. So when we looked at the total addressable market, the opportunity at hand today, I think it was very obvious for us that this is best offered in a corporate IPO that gives the incoming investors and the existing investors the opportunity to continue to ride the wave of growth in Horizon. And coming to your initial question on what happens post the IPO, you're absolutely correct. Our intent is that, along with the 2,600 crores of IPO proceeds and the 1,650 crores that we raised as pre-IPO, that goes as growth capital in the company. It's 100% primary. The intent is to deleverage it and effectively create a lot of growth headroom in the company. As your interest bill goes down to third, the fact that your top line is almost doubled in the last 3 to 4 years means that the free cash flow generation in the company going ahead is also going to be significantly improved. So that, along with the growth headroom that we created, effectively is going to pave the way for the next level of growth.
I have a few questions for Ashish here. Ashish, you said in your presentation that Blackstone owns a lot of logistics parks across the world. How is India different? What have you done significantly different in India? And also, does Blackstone own any more logistics space outside of Horizon in India?
I think I think one of the things that we sort of looked at when we looked at our global logistics portfolio was the opportunity set that we saw in India. What we realized very quickly when I spoke about this was the under-penetration that we had in India compared to any of the global markets. So one of the things that we did differently in India was do more development. Across the world, we have owned and acquired more institutional grade stock because that was something that was just available. When we looked at the Indian markets, we had some stock that was available that was institutional grade, but a lot more that needed to be sort of built from a ground up perspective. And I think that's what Urvish spoke of when he spoke about the growth potential that we see. There needs to be a lot more development that needs to happen in the sector. And I think that's the big difference that we saw between what we've done globally and what we've done in India. The second question was...
Do you own any more industrial?
We do, because this is a sector that we continue to sort of invest in. Under Horizon, obviously there was a cutoff that we had to sort of bring certain set of pipeline assets. The idea is, however, to sort of consolidate everything into Horizon, over the course of the next few years. But there are a few assets that we have to sort of keep outside of Horizon.
I have a Sapna from Realty Plus magazine. My question is both for Ashish and Urvish. For Blackstone, what changes going public, staying institutional investor now? So what changes for Blackstone? And for Urvish, do you anticipate any changes in your operations development post going public?
So I think from a Blackstone perspective, what going public sort of gives us is the ability to do much larger projects at scale. I think that's the opportunity set that we are seeing. That's what the flexibility that capital markets give you is to do much larger projects. And I think that's what the intention is. If we see when we started off this business, you had 100-200,000 square feet leases, which were large leases. Today you're signing 1 million, 1.5 million square feet leases, and they have now become par for the course. So this is becoming an asset class that requires you to deliver at scale, and that's what tenants are demanding. And that's the reason why we created Horizon with a fully built out team, because it's not only acquisitions, it's leasing, it's development, and we've got all of these skills under one umbrella. So that's the idea for Horizon.
Absolutely. And just building from where Ashish left effectively, and in the last 5 years, a lot of the hard work in terms of putting the building blocks, coming up the learning curve in terms of building this big, large, institutional grade industrial warehousing parks, all of that hard work has already gone into the company. So I think going forward, what we believe is the pace of your, and as you saw that in the stat on the page, your own development and throughput in the company today is almost gone up to 300% in the last 4 to 5 years. And today, just the addressable market, the way this institutionalization is just happening, we believe that our scale of development and leasing only goes up from here. Whether we public or private, the fact that the team, the development expertise, etc., has already put in, that just only helps us to consolidate even further.
So being listed is going to help in terms of scaling up, or maybe compliances are going to create some challenges?
Well, we have always done this, coming this out of the Blackstone stable, when we always ran in the most compliant way, any which ways. In terms of the build quality, in terms of your governance, your compliances, this will always run as a board-driven company from day one. So I don't think that materially changes our life going forward.
Thank you.
So managed company here. Basically, as we have an industrial park, so there will be monopoly or the segments which are going IT or chemical hubs or something like that. In the mind, or you have a plain vanilla type, like everybody and everybody.
So see, from our perspective, what we want to do is create as much fungibility in our business. As I alluded to when I was doing the presentation, when we effectively diversified from warehousing and now started to take care of some of these industrial customers, what didn't change was the fact that the same ecosystem, or the same infrastructure, the same kind of real estate, the core share of the buildings, that didn't change. That what that allowed us to do was effectively become very, very agnostic about what sectors we are catering to. So today, if you come to a typical park of ours, 100 to 150 acre park, which has 10 to 15 different buildings in it, 2 to 3 million square feet of total real estate at a single location, you pretty much see a large e-commerce company coexisting with a large 3PL company, coexisting with a large warehousing company, coexisting with a company which is making data center equipment. So there was no real intent for us to go and say, okay, this park will only be an IT semiconductor park, and tomorrow a 3PL company comes and says, no, we're not going to entertain you here. So that would not have actually served the purpose. What we did was create infrastructure and real estate that could be effectively used by any of these customers. So if you see like this is a model park, or you see any of our park, most of the buildings look effectively the same. But what happens inside those buildings effectively changes. So
Yeah, continue to.
so that's why. I just want to round up saying that today we are agnostic.
Yeah, and some of the industries require the manufacturing and the depots separate. So you have any loyalty programs?
Yeah, look, some of those customizations we always do for our customers. We're the most flexible company in terms of trying to serve our customers to the maximum. But 90%, or I would say, my answer is that 95% of the demand that we see, over nearly 28 million square feet of leasing that we've done, has effectively gone in very, very standard infrastructure. And why that has happened is because we kind of perfected the art of what works for these 90-95% customers. The build specification, the heights that we are giving, the apron area, this is a little slightly technical, but learning from the Blackstone parentage, learning from our sister company, we perfected the art of what kind of works for 90-95% of our customers. And then the marginal customizations always, they're always welcome and we always add to the place.
There are two questions adding on to the gentleman. So people want to know, what is the incremental leasing? Is it going to be towards industrial or fulfillment? Because right now you mentioned it's close to 50-50. But in the next couple of years, how do you see this shift?
As I said before, from our perspective, we are 100% agnostic. We build infrastructure which serves both those customers base. But having said that, if you see the trend in the last couple of years, yes, we have been able to attract a lot of these marquee industrial customers to our parks. As I said, as this Make in India, the PMI started to bear fruits on the ground, a lot of these American, European, Asian companies entered the country, effectively looking at plug-and-play facilities to get their operations started. And that's where effectively the gap that we are bridging in the market today. You know, our parks effectively built out of infrastructure, this high-grade quality real estate, meant that these were customers who said, you know, we've used this facilities in Germany, in US, in Japan, and effectively getting that in India. You know, so they were the first adopters to something like this. But having said that, the adoption with some of the Indian customers is also changing dramatically. So, you know, again, rounding up on what you asked, you know, 2/3 of the leasing in the last couple of years has happened towards the industrial end of the segment, which is kind of like allowed us to diversify nearly 50% now. I see no reason why some of these trends should abate. In fact, with, you know, call it the industrialization 3.0, your modernization of ports, etc., some of these things should only get more essential going forward. But when we, diversify, and I think what I said earlier also was, in all of this, we didn't have in-city.
Yeah.
Now, in-city, 7 million square feet, nearly 25% of the top line, gets added to this diversification over the next 2 years.
Okay, there's one more on industrial, which is why I asked this as well. They said, how much capex you think an industrial guy is putting per square feet?
Great question. You know, sometimes we are amazed that some of these deep industrial customers, and you know, when some of these customers used to come to us, we used to think about, you know, what will be the longevity of some of these. Why would they not go and own their own facilities? Why would they not go and buy their own lands? Only to be surprised that in most of these cases, these customers end up actually investing more than what we've invested in the building and the infrastructure, right? So that tells you that these are effectively customers, and this is what happened in the commercial segment also, right? Today, if you think about the GCC trends, if you think about the IT trends, you will hardly come across any of the GCCs wanting to build their own real estate, right? So, coming to the point, these guys are effectively using this as their primary plants or the primary facilities to either warehouse or run their assembly lines. So, yeah, they in fact end up investing almost equal to what we invest in these buildings.
Hello. Sir, you have more than 120 clients. So, have you ever felt any shortage of space in your parks? As you have mentioned, you have more than 130 clients at present. So, in India, have you ever faced any shortage of space in your location, industrial parks?
As I said, we are building to a very, very different institutional scale. Right? As I said earlier in the presentation, we're not looking at building 1 or 2 buildings. These are effectively parks with 100 to 150 acre land at a single location. Our intent is to create and allow our customers to grow within these parks. But yes, over the last couple of years, we have seen parks which are effectively fully leased out today. As we were talking from our build and lease perspective, right?
I guess to answer your question, I think, development cycles are about, call it between 6 and 12 months to put up a warehouse, and therefore, at a point in time, you might run out of space in a particular development, because you're obviously anticipating what the demand is, but sometimes if it's more, then for a point in time, you might run out of space. But the good part about this business is development cycle, like I said, is 9 to 12 months. So you typically will have, if a tenant's really interested, they will typically wait for another 6 to 9 months to take out that space. But once in a while, you might lose a tenant if you don't have anything available.
So after this IPO, you will give more importance for acquiring property or leasing or the acquisition. What way you will move?
No, if you look at the company today, you have about 30 million square feet that can be built going forward in the company, just on land that it owns today. So the idea is that this 30 million square feet will be built over the next 3 to 4 years. In addition, I think you will also look at acquisition. So the money that you will use going forward is going to be a mix of development of the existing land bank plus potentially acquiring additional land bank that sort of comes up.
Ashish, double clicking on that, any further primary capital requirements? And how would you fund the growth from 30 to 61 million? And when you're talking about acquisitions, what's your strategy to fund the acquisition?
If you break this up, in the past, if you look at our track record, we've acquired about 5-6 million square feet every year. we built about 6 to 7 million square feet of area, and that's the run rate that we want to try and go forward with. If you just do that, I think this company will not require any more capital going forward. I do think, however, that there are larger scale opportunities that are coming up, and multimodal corridors, freight corridors that are opening up, which require larger investments at scale. So for some of those, you might require more primary investment to come up. But if you just sort of go with what you've been doing in the past, the existing 60 million square feet will be built with no more incremental capital, and you will still be able to acquire 4 to 5 million square feet going forward.
There's a question on leasing. People want to know what's the basic leasing terms you have with your clients in terms of leasing period, escalation, etc. Also give us a view on pricing so that we are able to understand the company's trends.
So the average lease term that we have defined on leases is 4 to 5 years. That's the average lease term that we have. And in terms of rents that you see, there is a continuous rent growth happening because we have at least a 5% year on year, 4.7 to 5% year on year rental growth, which is there in almost every lease of ours.
Just to add, round up on that, so typically industrial customers might actually end up even asking a 9 to 15 year term also. And that also comes with a similar kind of a lock-in on some of these, right? So high quality customers, high lock-ins, annual escalation that Pooja said, we almost get 5% annual escalation on all our leases today. So that's a typical leasing term. What was the second part of the question?
Is it, it's about the pricing. Are you premium? How are you priced?
Oh yeah, 100%. As I said in the presentation also earlier, today what you are catering is to the premium most customer end in the market today. As I said, maybe 2/3 of your customers are this Fortune 500 global multinational company. These are guys who need the best-in-class infrastructure, best-in-class amenities, best-in-class ecosystem. Once you provide that, your pricing is obviously premium. So we have almost maybe 5 to 10% premium to even our adjoining grade A partners compared to grade B, grade C. There's substantial premium. But again, these are customers who are choosing you for compliance, for a balance sheet strength, for execution capability, for the quality infrastructure that you bring in. The fact that you're allowing them to go to market in a record 3 to 6 months, you're giving them institutional scale real estate, right? Pricing, of course, is important, but not the primary reason why they choose.
There's one more on in-city. People want to know, when you say in-city, do you mean it is for smaller e-commerce players like Blinkit, Zeptos, etc., or does in-city cater to industrial as well?
No, absolutely. I just saw that on the page. In-city today is this is just about getting started. If you think about this, it not only caters to your e-commerce companies, but there are a lot of these companies who are effectively running their R&D facilities, they're running their these light assemblies, where they don't necessarily need the 200, 300,000 square feet space, but they need speed to market. They need to be closer to their customers. These are people who require high degree of engineers, professionals, needs that is not in the outskirts of the city. So, but are being served by the industrial galas, etc. which today in this DNA age does not match the kind of quality production that they are doing. So, no, this absolutely. While this is predominantly warehousing space for exponential sectors, as I mentioned, for service centers, for cloud kitchens, but yes, we are seeing a lot of demand actually come to us today for the 5,000, 10,000, 15,000 square feet high-end precision equipment manufacturing, R&D labs, etc.
Yeah, there's one I missed. Okay, you mentioned that you compared India and Chicago in terms of your total size. Is there an estimate done by anybody to explain India's total addressable market of grade A warehousing and logistics assets?
Great question, Rita. A total grade A stock in the country for a population of 1.5 billion is actually pretty appealing. Just 350 million square feet of total stock, which is a quarter of the stock in a Chicago single market alone, right? But coming to your question, has somebody done this? Yes, some degree. Today it's very difficult today actually be able to go out and count all the grade C, grade B stock in the country. But as I alluded to earlier in the presentation also today, I think the total addressable market here is probably in like 5 to 6 billion square feet, right? I'm not saying 100% of that ever converts to grade A, but I'm saying a fraction of that converts. You're looking at almost like the sector continuing to double every 3 to 4 years what it has done in the past decade.
Fantastic. To Kunal, how much debt will remain on the books after the payment, after the IPO? I think we have answered that, but are you comfortable with the level of debt, or will you look at more leverage going forward?
So, post the IPO, we got to answer that. I think we have somewhere about 2/3 of the debt paid down. Okay, and after that, like Urvesh and Ashish mentioned, we will definitely have a lot of growth capital coming in. So we don't see a very significantly of numbers on the debt to EBITDA margins. We will hope to it will be in a stable course.
His last question on land acquisition. Anybody else on the floor before I take the last question? Okay, so to Mahinder, how difficult is it actually to acquire new land, and how have you seen land prices grow in the last 4 to 5 years?
Land is the difficult piece of application in India currently, but always we are talking to all the state governments and various agencies, and we are very well versed with the process of acquisition over here in India, and we are acquired almost 2,300 acres by now, and in future also we see a lot of potential from state government and our understanding with all the medicine and so on and so forth.
Just double clicking Deepa on what Mahinder said, yes, land is continues to be a key subject in this country, right? The fragmented nature, the litigated nature of the land, it is incrementally a very, very high note for a business like ours, which already is sitting on 300 acres of aggregated land parcels, right? So the beauty, as Mahinder said today, is with 2 decades of hard work that Blackstone has put in the country, means that every large IPC, every large landowner today, every JV partner is effectively known to you today. So that kind of becomes a very deep pool of opportunities that get created from there. And the other thing is, obviously, we've been, and how we've done in the past, we continue to scale up and use some of these industrial bodies, like what we've done with MIDC, like what we've done with KIDB, to effectively get very high quality real estate land in some of the very, very key and deep industrial markets.
If there are no further questions, I'll just request if there are questions, keep typing them, we'll take them and we'll answer it offline. For closing, may I invite Mr. Amrinder Singh, Executive Vice President and Group Head, SBI Capital Markets Limited.